Every economy needs a scorecard. We use national income to measure whether a country is actually getting richer and to test if its macroeconomic policies are succeeding. This diagram illustrates economic growth, an increase in a country's real GDP over time, representing expanded productive capacity. Writing just an increase in output gets partial marks. You must specify GDP is real, adjusted for inflation, and happens over time. Missing these qualifiers loses marks. To measure average living standards, we switch to GDP per head. You can secure the full 2 marks for this definition simply by writing the correct formula: total GDP divided by the total population. Locking in these precise definitions gives you the foundation. We will use these exact concepts to build the structure for the 6 and 8 mark analytical questions coming up. For our first challenge, we will tackle a 6-mark question from the November 2020 paper. We need to analyze how a rise in investment increases a country's economic growth rate. The most common mistake here is skipping to the end. Students often write that more investment simply equals more growth, missing the macroeconomic steps in between. This diagram outlines the exact logic chain the examiners are looking for. A rise in investment initially increases total aggregate demand. Firms spend this money on new capital goods, bringing advanced technology into the economy. With better technology in place, the workforce becomes more efficient. This raises the economy's overall productive capacity, which naturally causes the costs of production to drop. Lower costs mean lower prices and higher quality. Domestic consumers and foreign buyers will demand more of these products, leading to a direct increase in total output. You earn the full 6 marks by exposing this entire sequence. Every gear has to turn the next one to prove the final outcome. Let's scale up to an 8-mark discussion from the June 2021 paper. Is a lower GDP always a disadvantage to an economy? This visual represents the obvious side of the argument. Less production means firms need fewer workers. That triggers higher unemployment, lower average incomes, and reduced tax revenue for the government. Standard living conditions drop. Before we look at the other side, think for a second. What could possibly be an advantage of an economy shrinking? The other side of the scale focuses on the environment and quality of life. Less industrial production means reduced pollution and a slower depletion of natural resources. A slowing economy can also lead to lower inflation and less workplace stress. There is also a critical demographic exception to consider. If a country's total population falls at a faster rate than its overall GDP, the individual GDP per head will actually increase, improving average living standards even as the total economy shrinks. Achieving all 8 marks requires looking past surface-level economic assumptions. To evaluate the economy accurately, you have to weigh these external factors and demographic shifts against the raw data. We will finish with a quick 1-mark trap from the November 2024 multiple-choice paper. The question asks, what is GDP divided by to calculate GDP per head? Let's look at the calculation options. Because GDP per head measures the average income per person across the entire country, the denominator must always be the total population. You cannot let options like the working population or adult population distract you. Remember the 3 rules for national income. First, always qualify growth as real and over time. Second, map out every single step in your cause and effect chains. And third, always weigh the environmental and demographic counterarguments in discussion questions. Top-tier marks depend on your ability to structure logical, balanced arguments that connect every piece of economic evidence. Fundoo Tutor is a personalized learning platform that helps students succeed in Cambridge, IB, and other international curriculums,